Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, a look ahead to this week's Fed meeting, what it means for monetary policy. I'm Tom Busby in New York.
I'm Caroline Hepke in London, where we're looking ahead to the Eurozone's big economic data drop.
I'm Ryan Curtis in Hong Kong. We look ahead to the machinations of one key central bank. And then what's next for a key industry that would hope to curb the power of central banks.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby. We begin the program with a look ahead to this week's Federal Reserve policy meeting, a decision on rates expected on Wednesday. 20 meetings in a row with either a rate increase or no change at all. Will the Fed finally vote to cut rates? For more, we're joined by Michael McKee, Bloomberg International Economics and Policy Correspondent. Michael, I think the handwriting is on the wall. What are you expecting to see, though, this week from the Fed?
The handwriting's on the wall, and for the first time, as you mentioned, in a very long time, we're actually going into this saying it matters what they do. For so long, we've been saying they're stuck, higher for longer, and it doesn't matter what they do at their meeting. It's going to be what they say about the future. Well, now it's going to be both, because there is this slight chance of a 50 basis point move because they didn't officially rule it out before the quiet period began. Nobody really thinks that's going to happen, but it's out there. So that'll be the first thing people will look at is how much did they cut? And so that will be important. Then we get the summary of economic projections, new forecasts for the economy, and the dot plot, and that'll capture some attention as well.
Now, the Fed has always said we are data dependent. Any move we make all depends on the data. Let's talk about the data. We saw this past week consumer and producer price inflation. How will that factor into this decision? Kind of a downside surprise.
Yeah, well, that's what cemented, I think, the view that we'd do 25 instead of 50 and really took away the hope of the 50s folks. Because while we got a very small increase in core CPI over what was anticipated and the same in PPI, it doesn't suggest that the inflation is going to be going the other way or there's a huge danger of inflation accelerating. It just shows that the battle is not won yet and the Fed can't rest on its laurels. And so that's why people are saying they shouldn't go 50 because that might send the wrong message. They want to send the message that we are still vigilant against inflation and we're going to keep an eye on it. And as last week, Christopher Waller from the Federal Reserve said, if data from this point on show that 50 is worth doing, they can easily do that. But right now, they're not ready to.
Now, some of the people who are calling for a 50 basis point cut think the Fed waited too long to initiate this cut, that they kind of missed the boat at the end of July, and we saw some very troubling data about jobs. We saw, a little uptick in inflation growth. Do you think they missed the boat? Do you think, or is it steady as she goes and they're on the right path?
Well, it's impossible to say, except in hindsight, that they were behind the curve. The argument is that, as you noted, the labor market has slowed a lot. We haven't seen consumer spending really slow yet, except that the people's savings are kind of dwindling. And so there's a feeling that's going to happen at some point. The thing about recessions is they're based on confidence, and all of a sudden people lose confidence, both consumers and businesses lose confidence in their ability to pay for new, what economists would call investments, stuff you buy, and so they pull back on their spending. And right now it doesn't seem to be the case. Businesses have slowed down. We don't really know whether that's because they are waiting, and it does seem logical that they are waiting to see the results of the presidential election and what the tax and regulatory regime will be like going into the new year. Consumers through the back-to-school season have been spending. We'll see if that continues. But the latest indications from the high-frequency indications from retailers are that people are still spending. So it doesn't look like there has been a seizure of lack of confidence seizure among people yet. So it's hard to say with any certainty that they may or may not have missed the boat. The only thing that you do know is that it takes a long time for monetary policy to hit the economy. And you're going to hear after Wednesday, especially Donald Trump, who's already said this, the Fed shouldn't be cutting rates, and it's going to be unfair, and it's going to be a boost to Biden and Harris. But it's not, because you won't really see any impact on the economy until next year from even a 25 basis point cut. So if things deteriorate between now and the end of next year, you could say they got behind the curve, but we don't know yet.
Well, we have a big decision this Wednesday from the Federal Reserve. Our thanks to Michael McKee, Bloomberg International Economics and Policy Correspondent. For full Fed coverage, be sure to tune in Wednesday at 1:30 p.m. Wall Street time for a Bloomberg surveillance special, The Fed Decides. Join Tom Kane, John Farrell, and Lisa Abramowitz as they break down the decision with the biggest names in finance, economics, and business. That's 1:30 Wednesday on Bloomberg Radio and Television. We move now to the logistics and services delivery giant FedEx. And with its busiest time of year nearly here, FedEx reports first quarter earnings this Thursday. So how will an organizational restructuring impact its earnings ahead of the holiday season? Well, for more, we're joined by Lee Klaskow. He's Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. Well, Lee, let's start with what you expect to see in FedEx's earnings report this week, coming off a very strong Q4 in June.
Yeah, well, thanks for having me. I think that FedEx should report another solid earnings report. They were a show-me story for so many quarters, and they've really shown the market, if you will, that they can execute on their strategy. They have a bunch of restructuring plans that are underway that are expected to save significant money, over $2 billion in fiscal 2025, on top of the $1.8 billion that they saved in 2024. So, they're really doing all the right things. The restructuring their businesses into one main reporting business. They are changing the way they operate their air fleet, and they're really taking costs out, something that company didn't do for a long time. It really became an old, fat company, and they're really taking a good look inside and making it a much more productive organization.
Well, they also laid off tens of thousands of workers in the last year or so.
Yeah, I mean, that's always an unfortunate event, but they like I said, there was a lot of fat, if you will, that needed to be trimmed, and with the advent of technology advancements and productivity tools that they're able to use, you just simply don't need as many people as you once did, whether that's on the dock or in accounting.
Does robotics play a lot into that?
Not so much robotics for FedEx. I mean, they have really state-of-the-art sorting facilities across the country and the world, that does a lot of that automation, and that's able to save not only time, but money for the company. So that is definitely a net positive, but that's not really what's driving, I would say, the head cuts. A lot of the headcount reduction is really on the corporate side.
Now, in addition to those job cuts, there's also capital expenditure. They've really pulled back, or are they just, realigning
so
things?
FedEx was famous for buying a lot of planes, maybe even if they didn't need them. What they have done is they've refreshed their fleet into a much more fuel-efficient fleet, getting rid of some of the older, less efficient planes. And they're also parking a lot more equipment. So, the reality is they don't need as many planes as they once did. And not only do they not need as many, but, not just because from a restructuring of their air freight network, they also don't need as many because a lot of the planes either can do more with less, if you will.
Now, speaking of freight, you have reported that there's a possibility of them spinning off that freight unit. Is that still in play?
Yeah, so their freight unit is their less than truckload business. It's a very good business, but it's currently under a strategic review. We expect that could generate an enterprise value of between $30 and $33 billion for the company. Right now, the less than truckload market is having a little issues with demand. Demand is down for a lot of of the carriers that are in the market, and the reason for that is we're really coming up against tough comparisons. One of their large competitors went out of business last year, and we're kind of past that anniversary. Also, the ISM has been in contraction territory for something like 21 over the last 22 months. So that's not great for LTL demand because it tends to be a leading indicator.
Now, a lot of businesses and consumers pulling back on spending. Times are tight, especially as we're coming into the holidays. Do you think there's going to be a lot fewer packages? People choosing ground instead of air? I mean, will this affect FedEx in the coming months?
Yeah, so the consumer is obviously an important constituent for not only FedEx, UPS, Deutsche Post, but really all modes of transportation that I cover. We're relatively bullish on the consumer. We think that a couple things are going to happen. We are transitioning back from buying services to now going back to buying stuff. We also believe that we are going to have a real peak season this year because of that, and seasonality is coming back into the market because we've gone so many years from the pandemic of these crazy dislocations that made comparisons next to impossible. So, we're getting back to seasonality. We think there's going to be a peak, which I think could surprise demand on the upside, and we're really going to be paying close attention during the earnings call on Thursday on when management talks about, what they are expecting from peak from their conversations with their shippers.
Well, FedEx fiscal first quarter earnings out after Wall Street's closing bell this Thursday, and our thanks to Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. Coming up on Bloomberg Daybreak Weekend, a look ahead to the Eurozone's big economic data drop. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, we look ahead to a meeting from one of the key central banks in Asia, the Bank of Japan. But first, as expected, the European Central Bank cut rates again at its most recent policy meeting, 3 months after its first cut in 5 years. Will lower borrowing costs lead to economic prosperity for the bloc? For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, in Europe it seems that rate cuts are like buses. You wait 5 years for one and then two arrive in quick succession. When the EU became one of the first major central banks to cut its lending rate this summer, it touted progress made on tackling inflation. This time round, the bank delivered another 25 basis point cut, citing further progress against their economic goals. But European Central Bank President Christine Lagarde says that euro area growth risks are now tilted to the downside. Speaking at a news conference in Frankfurt following the committee's decision to once again lower borrowing costs, she emphasised the importance of economic data going forwards.
So the Vice President and I welcome you today to our press conference. The Governing Council today decided to lower the deposit facility rate, the rate through which we steer the monetary policy stance, by 25 basis points. Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, it is now appropriate to take another step in moderating the degree of monetary policy restriction. Recent inflation data have come in broadly as expected, and the latest ECB staff projections confirm the previous inflation outlook. Fiscal and structural policies should be aimed at making the economy more productive and competitive, which would help to raise the potential growth and reduce price pressures in the medium term. Mario Draghi's report on the future of European competitiveness and Enrico Letta's report on empowering the single market stress the urgent need for reform and provide concrete proposals to make this happen. The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth. We have consistently said, and we repeat again, that we shall remain data dependent, and that is particularly justified in view of the uncertainty that abounds.
That was the European Central Bank President Christine Lagarde speaking there. Despite the upbeat sentiment of Eurozone policymakers, growth is faltering across the region's largest economies and consumer confidence remains below pre-pandemic levels. The ECB's latest projections downgraded output over the next 3 years, whilst the outlook for underlying inflation nudged higher for this year and 2025. In the coming days, markets will receive more European inflation data alongside the Bloomberg September Eurozone Economic Survey, which may help to guide the 2 remaining ECB policy meetings that are left this year. All of this is something I've been discussing with Bloomberg's senior Euro area economist, David Powell.
Yeah, the most important data point we'll be getting this upcoming week for the euro area is that final reading on CPI for the month of August. And that will allow us and others to look at, have a more granular look at underlying measures of inflation. But basically, broadly speaking, those measures are coming down. The headline number isn't very far from the ECB's target right now. And they're all moving in the right direction. The real number that's of concern to the ECB is services inflation. That has remained uncomfortably high at over 4%, and that's what the ECB is focused on. This is the second reading, so it's unlikely to move that much from the first reading. So it'll be more important for the ECB, though, in terms of inflation. We get the reading for September, and that's out on the 1st of October.
Is there a danger that the ECB has been overconfident on tackling inflation? They haven't ruled out a further cut in October.
Well, the ECB's policy rate, the deposit rate, is in very restrictive territory. We think that kind of a neutral level would be about 2%. So monetary policy has been very tight. We have seen that in the economy, with the economy having flatlined for a long time in the euro area. And they have made significant progress on inflation. Like I said, the headline number is now very close to the target. And when we look at measures of cost pressure, so wage growth, negotiated wages, things like that, they're all moving in the right direction. And the ECB can't wait until they're actually there to cut, because monetary policy operates with a long lag. They've got to be more forward-looking, and they see everything going in the direction they want it to be going, and I think monetary policy can be less restrictive now.
The expectation, though, is for the economy in Europe to remain under significant pressure. You saw it in the ECB's forecasts from this week's bank meeting. How will markets react if the incoming economic data isn't positive? Will there be concerns that the ECB has left it too late?
Yeah, I think generally speaking, in the euro area as well as in the U.S., so around the world, there are concerns that that tight monetary policy is really taking a toll on the economy. And of course, the markets react negatively when we get this bad data. We're seeing that not only in Europe, but in the U.S. as well.
And so in terms of what that means for others who are affected by interest rates, particularly for the European banking space, what do you expect from that?
Well, a lot of banks, of course, have benefited from the rise in interest rates, because their interest rate income has gone up, and then they'll have a negative impact as that comes down. Although it won't be immediate, because for many of these institutions, they have longer term assets and liabilities. They will be benefiting for a while from higher interest rates, and we've seen that in the government bond space, where Italy has had very high demand for its bonds in recent auctions, in order for investors to take advantage of these high interest rates before they come down.
What will be the effect on the European Central Bank if the Fed cuts by 50 basis points in the days ahead?
Well, the ECB has been moving at its own pace. The ECB cut before the Fed, and so it really is setting monetary policy based on what's happening in Europe. Having said that, they're of course not ignoring what the Fed does. What the Fed does is an impact on the exchange rate, and they'll be watching it closely. If the Fed were to have an aggressive move, it would probably increase the probability of the ECB moving more aggressively as well, meaning it would increase the probability of a move in October, although at this stage we don't think that's likely.
What do you make of the idea of higher for longer? Is that really true for Europe?
Well, we've moved away from that now. The ECB had its first cut in June, and then we had a cut yet announced. And we think the ECB will cut again in December. So the higher for longer idea is this idea of kind of reaching a plateau, as the chief economist of the Bank of England referred to it, a table mountain approach. We kind of get up and it's very flat for a long time. But this isn't looking like Table Mountain. It's looking more like a peak that we've come down, and we think will continue to come down after December into next year. We'll probably be having cuts at a quarterly pace.
How much concern is there within the ECB around the growth prospects of Europe? I mean, the US also is perhaps cooling, but only a little, and the underlying strength of the economy has been evident for months. China's seen kind of a lot of big disinflationary pressures. How much concern, and Europe is exposed to that, how much concern is there within the ECB about the slowing pace of the economy?
Well, the ECB has a single mandate, just inflation, whereas the Federal Reserve has a dual mandate, focusing on inflation and employment. So the ECB doesn't have to pay as much attention to employment as the Fed. But of course, in order to meet its inflation objective, it has to look at what's going on in the economy, because an economy that's too weak will produce inflation that's below target. And we saw that for many years preceding the pandemic. But at this stage, they're really focused on the inflation numbers as a whole, although there are voices that are becoming increasingly concerned about the slowdown in the economy and the potential for that to lead to an undershoot in inflation eventually. And that's probably why we've seen some support for a back-to-back cut at the ECB, meaning another move in October, as was reported by Bloomberg News.
David, there's always concern amongst the different members of the European Union and the Eurozone, indeed, about the differing performance of certain countries and whether or not interest rates happen to suit them at the particular business cycle that they are in. Who is most worried now?
Well, when we look around Europe, the various economies are performing differently. The president of the ECB, Christine Lagarde, highlighted at her press conference for this month that Spain and the Netherlands are doing very well, others are not. If there's one country that's not doing well right now, it's Germany. Germany's industrial sector has had a number of hits in recent years from high energy prices as a result of the war in Ukraine and softening demand in China, which is one of its largest export markets. And it really does continue to kind of be in the doldrums right now. And it's looking like the sick man of Europe, as it was called for many years before labor market reforms were introduced.
My thanks there to Bloomberg's David Powell for taking us through the data to watch when it comes to the European Central Bank. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thank you, Caroline. And coming up on Bloomberg Daybreak Weekend, we look ahead to a monetary policy decision from the Bank of Japan. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. We turn now to Asia and what could be a big decision from the Bank of Japan, which is weighing just how far to adjust its policy easing settings. We get more from Bloomberg Daybreak Asia co-hosts Brian Curtis and Doug Krisner.
Tom, the Bank of Japan meets in the coming week, and the smart money is suggesting no major surprise is expected. But what are BOJ officials thinking? Well, a Bank of Japan board member says the BOJ will adjust policy provided the economy performs in line with projections. We welcome Paul Jackson to the airwaves, Bloomberg economy editor, to take a closer look at what we might expect. Paul, BOJ officials seem a little nervous here about the volatility that was caused by the rate hike in July. So let me go out on a limb and say not likely they will make a move this month.
Yeah, I think you're right there. I think it's a time to wait and watch, given the extreme volatility we saw after that July rate hike. Remember, this is only the second time the Bank of Japan has raised rates in the last 17 years. So we saw very sharp volatility afterwards. The Nikkei stock index had its biggest drop on record. Following the rate hike. Of course, one of the key factors was also U.S. data, which fed into the narrative for the Federal Reserve and rate cuts. So it wasn't just the BOJ rate hike that caused that volatility, but still, I think there's enough reason there for the central bank in Japan to want to just wait and see, look at market stability, and also to look at the impact of that second rate hike in July. So I think the widely held consensus for next week is there's going to be no move from the Bank of Japan. But that does not mean rate hikes aren't in the pipeline coming ahead.
Yeah, enormous volatility with the unwinding of that yen carry trade as well, which then brings to my mind the concern that the BOJ may have when it watches the currency perform in markets. Is there a kind of a comfort zone that the BOJ has, do you think, for the yen vis-a-vis the dollar?
Well, that's a very interesting question. Of course, the BOJ would argue that it is not targeting any currency levels. But let's face it, the yen has been extremely weak against the dollar. And while that really helps its global companies, its companies with a lot of exports, it inflates the earnings for those companies. For domestic operations, it's the opposite. It raises all the costs, puts pressure on them. And it also makes the power of the yen for the average Japanese consumer, especially for thinking of going abroad, much weaker. So in terms of levels, I'd say 160 is definitely too weak. We see a lot of talk about the yen getting too strong when it's between 100, 110. So we're a long way off that. But sure, the narrative is going to change towards is the yen strengthening too much. We get past 120, I would say.
It's hard to argue with the math at the moment. It looks like U.S. rates are heading down, that Japanese rates are heading up. And when you put that all together, it would seem to augur for a stronger yen. The pace is what matters, I suppose, the most. The pace was just too abrupt when we had the July rate hike. So some modulation there, but the yen will get stronger from here, right?
I think the yen is going to get stronger, but I think we should be wary of thinking that the Bank of Japan has seen that volatility and is now scared off hiking again. I think they've been very consistent in the messaging that no, if forecasts are met as we hope, then we are going to continue hiking. Now, is it going to be every quarter? No, I don't think so. But I think the consensus is that December or January is probably the timing for the next rate hike. And don't forget, we had a story with people familiar, and their views that BOJ officials see this idea that a nominal interest rate of about 1% is probably around the minimum level for the neutral rate. So if you think of it in those terms, that's 0.75% rate hikes that could be in the pipeline.
Paul, take a step back. Help us understand the macro view of the Japanese economy right now. Economic growth and inflation, how are they performing?
Well, the economy has been sputtering. We've been lacking consumption in real terms, and that's really down to inflation. Don't forget, Japan has not been used to inflation. It's had decades of deflation. The goal in Japan has been to create inflation, not crush it. So the optics are very different in Japan. Inflation at the moment overall is 2.8%. And that's been really weighing on consumer spending. So really, we're looking to see if the economy is kind of engaging gears and is now moving towards growth with a positive inflation cycle that allows more rate hikes.
Paul, thank you. Paul Jackson, Bloomberg Economy Editor. Next up, we segue from the world of central banks to the world of limiting the power of central banks. Cryptos. Coming up later this month, a very big conference, TOKEN2049. It's going to take place in Singapore. A lot of very interesting topics coming up, such as the metaverse, DeFi, NFTs, global macro, of course, Web3, DAOs, and a whole lot more. And joining us now on the program to discuss what might be said is Subhashree Ghosh, Bloomberg cryptocurrency reporter, with us in our Singapore studio. Suva, I know the U.S. elections is a big issue with regard to crypto. When we get to this Token 2049 Singapore agenda, what will the biggest issue be?
Firstly, I would like to kind of just give a quick summary about this Token 2049 because why we care is important. This is the most popular, most well-represented crypto conference globally that Singapore hosts every year. And this time there will be 20,000 people attending globally from across the world, which is double that of last year. Coming to your question over here, the main themes of as we go into the U.S. elections is, of course, what will be the outcome of the U.S. elections results on crypto, especially given that there are two candidates. One has very clearly talked about pro-crypto, stance. And then there is Kamala Harris, who hasn't yet given a very clear indication of her stance on crypto. So that will be a very big theme that I expect to play out in this conference in Token 2049, which starts next week. So we will clearly and very openly speak to a lot of venture capital funds, and there are big ones coming from US, from Europe, from all across the world for Token 2049 in Singapore. And we are going to speak to them to understand where will they put their money in, because in the back of the theme of US elections, there are a lot of projects as well. We saw in the last 2 years there were projects and companies which were moving out of US for a not so favorable climate towards crypto then. These are very crucial stuff that we're looking to cover from the crypto conference.
Cryptocurrencies, I think we can agree, rose in popularity pretty dramatically during the pandemic. And then 2022 happened. In November, the cryptocurrency crashed. There was a lot of conversation before that about venture capitalists interested not only in crypto, but in blockchain technology more broadly. Is now the notion of artificial intelligence really providing a lot of very tough competition for new money that would have otherwise maybe flowed into the crypto space or the blockchain space?
The thing is that, the money is, of course, the pot of money is limited, and venture capital obviously would like to optimize the returns for their LPs. When it comes to choosing between AI and crypto, of course, in the last year or so, AI was a fad, but we have been seeing that fad is slightly fading, and people are looking more for projects which are detailed use case rather than just pure play infrastructure, be it in AI or in crypto. So to answer your question in a short way, it's basically venture capital funds are looking to invest where the use case is more prominent than just going by the tag, which is either AI and crypto. And I think, personally speaking, that this will merge in this conference as well, where AI and crypto will come together. They will intersect, and we will see a lot of investors looking for those kind of projects.
There's a lot of technical aspects to to this. For instance, we've seen mining difficulty increase for Bitcoin. And you'd have thought that would lead to higher prices, and perhaps to a certain degree that happened. But Bitcoin has actually dropped about 10% since you had this software code adjustment. So you're seeing quite a lot of whipping around volatility in cryptos. Will that continue?
Interesting question. And yes, crypto is a volatile asset, and it is likely to go ahead in that way, like meaning that the volatility is likely to continue. Of course, the initial support was from the exchange traded funds that were there in US that piled up a lot of Bitcoins. But then after that, the initial demand fizzled out, and we again saw macroeconomic conditions, parameters like inflation, growth, all this taking over, and Bitcoin was reflecting that as well in terms of volatility. Going ahead, you bring a very interesting point about mining. Yes, the mining ban in China had an impact, but we are seeing, spurts of mining growth in different parts of the world. And that is giving rise to some kind of support on the Bitcoin prices at the back end of it. However, yes, Bitcoin is a volatile asset, and no one can say what would be the future of the prices going ahead, whether the demand and supply will continue to match to push prices higher or not. But this token 2049 will clearly show the trend of investor demand as well as what miners are saying over here, because that's going to be crucial for the aspect of what will happen to Bitcoin prices going ahead.
Suva, thanks so much for joining us. Suva Sri Ghosh there, Bloomberg cryptocurrency reporter. We'll have Dan Moorhead, the founder and CEO at Pantera Capital, speaking there. Mike Novogratz, a big name as well, CEO at Galaxy Digital. That's all coming up in this conference. I'm Brian Curtis in Hong Kong, along with Doug Krisner. You can catch us every weekday here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong and 8 p.m. on Wall Street. Tom?
Thank you, Brian, and thank you, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.